Welcome to this lesson on how we trade Forex and why it's the ultimate business. Now, let's be clear. We don't treat Forex as a side hustle or a quick gamble. We treat it as a real business, and in fact, one of the best businesses in the world. Think about how a typical business works. In any business, the goal is simple. Buy at a wholesale price and sell at a higher price to make a profit. Let's use a car dealer as an example. They buy cars directly from the manufacturer at an agreed wholesale price. Then, they sell those cars to customers at a profit. Sometimes they might even buy the car back later, but at a lower price because its value dropped. They profit both ways. Now, Forex is very similar. The big difference? You're not buying or selling physical products. You're buying and selling currencies. And here's the beauty of it. With Forex, you only need to trade a few hours a day. You have no overheads, no boss, no employees, no inventory, no office rent or bills. It's just you, your skill set, and your connection to the market. Now, let me be honest, it's not easy. But it can be mastered, just like any other professional skill. Once you learn it, it's yours for life. No one can take it away from you. Think about other high-income skills, like becoming a doctor, lawyer, or engineer. Those careers take years to master. Trading is the same. But here's the good news. With our structured system, you can master it in 6 weeks, or even less if you're committed. Sure, you could try learning Forex from random YouTube videos or a few books. But let's be honest, that often takes many years. Most people get lost in circles. They make some money, then lose it, again and again. With this course, we've cut that learning curve down, from over 7 years to just weeks. You're about to gain skills that can guarantee you an income for life. All you need is what you'll learn here. A laptop or phone, an internet connection, and that's it. You can earn from anywhere. So how do you actually trade Forex? It's simple at the core. You're either buying or selling one currency against another. Every Forex trade involves a currency pair, like Euro-USD. The first currency is called the base currency, and the second currency is called the quote. If you believe the base currency will rise in value, you buy the pair. That's known as going long. If you believe the pair will fall, you sell the pair, also known as going short. The goal is to profit from the change in exchange rates between the two currencies. This is done through a trading platform provided by your broker, where you can monitor prices, place orders, and manage your trades in real time. In upcoming lessons, we'll show you how to read price charts, place your first trade, and manage risk effectively. Now, let's take a look at how to make money trading Forex. Forex trading is the simultaneous buying of one currency and selling of another. The objective of Forex trading is to exchange one currency for another, in the expectation that the price will change. More specifically, the currency you bought, you want it to increase in value compared to the one you sold. Let's look at an example. You purchased 10,000 euros at the Euro-USD exchange rate of 1.1800. So 10,000 euros multiplied by 1.1800 equals $11,800. This means you pay 11,000 US dollars. When you buy, your account is negative balance. This is because money has gone out of your account to make a purchase. 2 weeks later, the exchange rate has increased from 1.1800 to 1.2500. Now you exchange or sell your 10,000 euros back into US dollars at the exchange rate of 1.2500. So, 10,000 euros multiplied by 1.2500 equals $12,500. This means you received $12,500, making a net profit of $700. When you sell, your account is positive balance. This is because money comes into your account for the sale you made. In summary, You bought 10,000 euros and paid $11,800. Then 2 weeks later, you sold 10,000 euros and you received $12,500. The $12,500 received minus the $11,008 you paid makes you a net profit of $700. It is this continuous exchange of currencies on a global scale that drives the change in value of currencies and creates the Forex market as we know it. Placing a trade in the foreign exchange market is simple and is all done online with no physical exchange. This will be covered in more detail in later lessons.
So, what is leverage? Leverage is one of the most powerful features of Forex trading. It allows you to control a much larger position in the market with only a small amount of your own capital. Think of it as a loan provided by your broker to increase your buying power. How does leverage work? Leverage is expressed as a ratio, such as 10 to 1, 50 to 1, or 100 to 1, showing how much more you can trade compared to your actual funds. For example, with 100 to 1 leverage, you can control $100 in the market for every $1 in your account. So, with 50 to 1 leverage, you can control a $100,000 trade with just $2,000 of your own money. This means even small movements in price can lead to big profits. But remember, the same goes for losses. As beginners, using leverage of 50 to 1 is very safe and more than sufficient to make decent profits. Leverage magnifies everything, both gains and losses, so it's essential to understand how it works before using it in your trades. Let's explore this further with some real-world examples to help make it crystal clear.
Here's an example of how to calculate profit from a long trade, also known as a buy trade. We're looking at the Euro-USD chart on the 5-minute time frame in TradingView using candlestick charts. You expect the euro to rise against the US dollar. At the core, here's the formula. Profit or loss equals number of lots times pip value times number of pips. This simple formula works for every trade you place. First, set your entry point by selecting the horizontal line tool and place it on the chart. In this example, you plan to buy around 1.1551. Next, set your exit point by placing another horizontal line at 1.1578. This is where you plan to sell and exit the trade. The market moves as expected. The price rises, and you close your trade by selling back the euro at 1.1578. Now let's calculate your profit. Your sell price, 1.1578, minus your buy price, 1.1551, you caught a 27 pip profit on that move. And since you traded one standard lot and each pip is worth $10, your total profit is one lot times $10 per pip equals $10, multiplied by 27 pips equals $270 profit. Just by catching a 27 pip move with the right lot size, you've made $270. Now what if you were trading more than one lot? Let's do the maths. If you traded 2 standard lots, you already know the pip value for one standard lot is always around $10 per pip. So for 2 standard lots, your pip value would be 2 lots times $10 per pip, which equals $20. And since you captured 27 pips, now your total profit would be 27 pips times $20 per pip, which is a staggering $540.
Looking at the typical trading scenario with a more favorable trading outcome.
Like the previous examples, you're still taking one trade per day, 5 days a week. That gives you 20 trades a month, split into 2 sets of 10 trades. This time, your strategy has a 60% average win rate, and you still have a £10,000 account balance. So out of your 20 trades, you get 12 wins and 8 losses. You're still keeping your risk-to-reward ratio at 1 to 2, meaning you're risking 1%, which is £100, to potentially gain 2%, which is £200. £200 on each trade. Let's run the numbers. Your 12 winning trades at 2% profit per trade each gives you a total of 24% gain, that is £2,400. Your 8 losing trades, each with a 1% loss, add up to 8% total loss, or £800. Now let's do the maths. 24% gain minus 8% loss equals 16% net profit for the month. That's a solid 1,600 pounds return, and it highlights the power of combining a positive risk-to-reward ratio, consistent trade execution, and even just a modestly good win rate. The key takeaway? You don't need to win every trade, but with the right strategy and discipline, your profits can still far outweigh your losses, month after month. Remember, you don't need a huge win rate to be profitable. 40% to 60% is enough. Even with a smaller account, you can earn the same monetary values by changing your risk percentage. Once you've mastered this course, our Forex Advanced course is your next step to unlock bigger profit potential and strategies for every market condition.
In this lesson, we will learn how to use the Currency Strength Matrix. You can access the Currency Strength Matrix on the ForexClass website, open FX Tools, and select the Currency Strength Matrix. The Currency Strength Matrix is a tool that measures the relative strength and weakness of major currencies at a specific moment in time. It compares currencies against each other and highlights strongest currency currently in the market, weakest currency currently in the market, potential pairs worth watching, and relative strength relationships between currencies. The matrix helps us identify strong currencies, weak currencies, and potential pairs worth investigating. Before we finish, remember that everything you've seen in this free lesson is just a brief introduction to the world of trading and investing. Inside the full Forex Trading Level 1 course, you'll learn these concepts in much greater depth through a structured, step-by-step program designed specifically for beginners. We'll guide you through the fundamentals, technical analysis, risk management, trading psychology, and the practical skills needed to start your trading journey with confidence. By the end of the course, you'll have a solid foundation, a clear trading plan, and the knowledge required to approach the markets like a disciplined trader. Thank you for watching, and I look forward to seeing you inside the course. Remember our motto, invest in knowledge, profits will follow. See you in the course.